Welcome back to today's video where we are diving into one of the most crucial aspects of successful trading, that is position sizing. If you have ever wondered how professional traders manage risk and never blow up their accounts, this is exactly where it starts. By the end of this video, you will know how to calculate your position size like a pro, protect your capital, and set yourself up for long-term success in the forex market. Now, once again, this is a continuation, in fact, a bonus to our treatment on how to master your entry and exit levels. So this is the second Jara or bonus video that I have decided to add. The first one is on how to read and understand the economic data or calendar. Right. The last one is on position sizing. So I bet you have been hearing this. This is actually a buzzword which is often thrown around, but for intermediate and advanced, sometimes this can be quite I don't know, the understanding them can be quite difficult. Right. So let's look at this in this video. So first of all, this is actually in agreement to what is called risk management. If you are able to manage your position size, then automatically what you are doing is managing your risk. You quite remember in one of our episodes on this particular series that we said something like being a good analyst doesn't necessarily grant you to be a profitable in this profession, because there's a lot that come into play when it comes to trading. The risk management will be there, the technical analysis, and even the psychology can actually be part of it. So let's look at risk management and the position sizing. So we look at the definition and then we look at the risk per trade. The position size is actually then examples, a walkthrough. So at the end of the video, I will show you some charts or a typical representation of what you do at CMG. Right, so without further ado, let's see what these things mean. So I'm just going to explain what position sizing is and why it is crucial for risk management. Risk per trade, talk about the importance of deciding how much of your capital you are willing to risk on each trade, typically 1 to 2%. Calculating position size, provide the formula for that. And position size, actually the formula is accounts risk. The risk, how much you are willing to risk, and then over into bracket entry price minus stop loss price. You understand the example, walk through and all that. So we talk about volatility, how we can actually adjust, make use of this key term, and then we move to position sizing. So now let's look at what position sizing is. After this, we'll do practicals. I'll show you some data, typical data. Now, risk management. Emphasize how appropriate position sizing protects traders from significant losses, especially during periods of high market volatility. We mentioned how sticking to your trading plan and avoiding emotional decisions. That's good. We look at scaling in and then scaling out, and then some common mistakes that people do or traders do. So now, what is position sizing? Right, position sizing. Now, position sizing is the process of determining how much of your capital to allocate to a specific trade. And this trade is a single trade that we are talking about, a position. Now, this is crucial. This is a crucial part of risk management because it ensures that you don't risk too much of your account on any single trade. Take note of this. You will need your writing pad once again and your writing pad. Now, by controlling your position size, you can limit your losses while giving yourself room for growth. So we are looking at a long-term growth. That is the main idea in this episode, in this channel. That is what we are aiming at. A long-term, successful, profitable trader. If you are here for just a few months or so, then I'm sorry, this is not going to happen. Right, so that's what we are looking at in preparation towards that. Now, second is the risk per trade. Now, before entering any trade, you need to decide how much of your account you are willing to risk. Most traders typically risk 1 to 2% of their total account balance on a single trade. We will look at this. For example, if your trading account has $10,000, you might decide to risk $100 to $200, right, dollars per trade in a single trade. This helps you to stay in the game even if you experience a series of losing trades. We call it losing streak. A whole week you can actually experience a losing streak, and that is normal. Sometimes it can even go beyond a month. I'm telling you. So be careful. Now, it's not like a holy grail. I tell you, if you have that conception, please change it. Now, point 3, how to calculate position sizing. This I will do practical of this. So just listen for this, about this, and the contrast side and pay size. Just listen to this. But it's good. If you are good at conceptions, then you'll be good here. Now that you know how much you are willing to risk, we are assuming, let's figure out your position size. Here's the formula. The position size, the risk, let's say $100 over the entry level, where you enter the price, where you enter the market. There's a price there, minus your stop loss price. We look at that. For example, if you are willing to risk $100, and the difference between your entry and price, your entry price and your stop loss is 50 pips, then you would divide $100, right? That's how much are we willing to risk, by into bracket the 50 pips, right? But there's, don't worry, we'll look at the specifics, don't worry. Now, point 4, introducing lot size and pip value. So for every move in a currency, a particular currency, there's a value to that. So let's say if Euro USD move a pip, or we call it the distance. If it moves one distance, let me say one distance, or a step, how much does that cost? So that is what we call basically pip value. Then we look at the lot size also. How much you are willing to buy, you understand, those units or quantity. You look at them. So in Forex, we trade in lots, which are basically bundles of units. Like we said, there are 3 common lot sizes, right? We have the standard lot. So the standard lot is 100 units. So for every 100 units, how much does it cost in a particular currency? So that is it. So typically it's around $10 for the general thing. But sometimes on JPY pairs, it differs. So that is it. You have to, we'll do the calculation. In fact, there's an automated way to do this. You don't have to worry yourself doing this on paper. But it's best that you understand how it is done. Then you move to the automation. That is it. Then we go to the mini lot. The 10,000 units is what $1. Then the macro lot, that's 1,000 units, what 0.1 dollars. You understand? Now to figure out how much a pip is worth, you need to know what lot size you are trading. So we look at that. If you are trading one mini lot, that's 10,000 units. Each pip is what? $1. So for every move in that particular trade, a pair that you are trading, every move in that is $1. So you have to know how much distance you want to engage in that in terms of the stop loss. Now let's move to point 5, putting things together. Now let's say you have $10,000 account and you are willing to risk 1%, which is $100, right? You want to trade the Euro USD pair and you have set your stop loss 50 pips away. Now let's calculate the position size, right? So you calculate the pip value, right? And then we calculate the lot size, and then we do that, blah, blah, blah. I don't want to waste much time here because I'll do that practically. Now, point 3 is how to calculate the position size, right? So we have introduced the basic formula for position size. We will need to convert it into lot size for you to understand. Still on that. So I don't want to waste much time here. Once again, I'm just going to move straight down to point 6. Point 6 also seems quite abstract, right? Still conceptual in the sense that people get confused about this, and this is actually used when it comes to stock trading. So when it goes to the financial market, we have different types of asset classes. We have the stock indices, we have forex, we have crypto, we have a lot of them. But basically, technically, these terms are tied to stock trading when it comes to contract size and all that, even though it's a borrowed term actually for forex trading, right? So I wouldn't like to bore you here. I will once again move to point 7. You can still read this, you understand? You can pause the video, read it. Let me move to point 7. Now, adjusting for volatility. Right. In volatile markets, you might need to widen stop loss to avoid being stopped out by random price movements. Now, when this happens, you would want to reduce your position size to maintain the same level of risk. For example, if the market is more volatile and your stop loss is now 100 pips away instead of 50 pips, your position size would be smaller to maintain the same $100 risk. Don't worry, you understand this, you appreciate this. So that's what I said. This looks quite conceptual, but if you're intermediate, probably you understand what is happening here, right? So let's move to the last but not least. It's called scaling in. Scaling in and then what? Scaling out. You understand? So what is this? Scaling in and scaling out. So once you understand position sizing, you can also start scaling in and out of trades. Scaling in means, now there's another term for scaling in. It means pyramiding. Pyramid. So pyramiding is also another term for scaling in. Right? Scaling in means you can you enter the trade gradually, adding more as the market moves in your favor. Scaling out means that taking partial profits, right, as the trade progresses, locking in gains while leaving some of your position open to capture more potential profit. You understand? So if I want to buy, and then maybe the total amount that I want to enter, actually, let's say my stop loss, is 50 pips. Now, 50 pips for the first entry, I don't have to enter all the 50 pips. So I can enter like probably 25 pips, right? So it means that whatever quantity, initial quantity, I'll just divide them into 2. So 25 pips, and then it means that the calculation will be what? If that calculation is $100, now the $100 will now be what? $50 because I've divided. So it means that if I get into a losing trade for that matter, I will have what? $25 lost, right? Yeah, lost. That is it. And then the other way, the opposite is true for when you are scaling out, right? So when it's going in well, then what do? You start with taking partials. We call it, it's the typical term or the common word is what? Partial, taking partials. So now let's move to the practical data at CMG Aura Space before I come back to the chart on how to do the calculation actually. So look here, I'm doing this on a phone, so it may look quite small, but you can actually pause it, zoom out, and then check the data actually. So this is actual data. This is not the dummy data. This is the data at CMG. What we are doing. We are actually putting everything into practice. We are not abstract people. So if you check here, we see at the top CMG's AUM, assets under management, right? That's what we do. Now here we have account size, we have profit target, we have the max DD, that's maximum drawdown, we have daily drawdown, we have personal DD instruments, and then we have a lot size. So this was actually prepared out of trading a profile, which I also use it for my real account. So what it means is that for every account, you have to have your trading strategy. You have something what? Your goal. For every account, set a goal. How much do you want to gain at the end of a period? Maybe you have to position yourself for a whole of 1 year, and then for 1 year, you are expecting a percentage of what? Maybe 50% of that account. So I have $10,000. So at the end of the year, I'm expecting 50% what? Profit. So it means that I'll have what? 15,000. Right? If I have 10,000, I'm expecting 5,000. I'm expecting what? 15,000 in total at the end of the year. So it means that once I've positioned this, I have to come down and do my position sizing. So that is where the real work actually begins. Because the fact that you have the idea of how much you want to gain at the end of a period, it is not enough. You have to be practical about it. So that is where a lot of people are lacking. For traders, we are lacking actually because we have not taken anything into consideration. We are just daydreaming, hoping right? Hoping, daydreaming, and then praying and all that, which is not practical. So after deciding on these things, calm down, take book, pen, write these things down. Now after writing these things down, I will also teach you again that when you go to myforex.com, the calculations are there. The pip value, how much you want to lose, the contract size and everything is there. But if you don't have this idea, this is where you do things in impulse. You act impulsively. Your emotion sets in. And by the time you realize an account of bigger size, which you were expecting a profit of maybe 50%, will be lost or be blown just within a week. That is bad. So account size, you have listed everything, account size there, put them, don't do things randomly. I have the account number, account size, the profit target that I have. So on a profit target, you can see that profit, I have two sessions, right? Profit, I have 10% for particular one, for the first one, 10%. And then, what is it? The profit target actually is what? 500. Then I move to maximum, right? So for the maximum, so if you see under, let's say, account size, account number is there. You have the account size, the 5K. And when you move to one, you move to what? You see profit. Now the profit target under that, you see 10%, and at the same time the figure there. So I don't just write the percent there. I write the figure down also. Right? So 10% of 5K is what? The 100. I put it down. Then I come to maximum what? Drawdown. The maximum drawdown means that I'm making sure that the account that I'm starting with, initial account, right, I am not moving below 6% or to 6%. That is correct calculation that I've done. A painstaking calculation that I've done. So you do this, you write them down. So maximum drawdown, you have what? Written that, the profit target, the percentage is there, the calculation, the figure is also there. Then you move toward the maximum drawdown. The maximum drawdown is that the amount that I've started, let's say 10,000. 10,000, I'm not moving below 6% under no circumstance. Because to me, whenever I move below that, it looks like I am not performing well. Or I'm doing things haphazardly. And for that matter, I have to check my training journal, the training strategy, and make changes or stick to it again. So once again, 6%, and 6% of that, or 5K, will be $300. So I'm not moving below that. Now, once again, I move down to the daily because I trade daily. Now, when I move to trading daily too, I have to know a percentage that I've set there. Now, in this case, if you see daily DD, it means that there's no DD, no DD. No DD means that in that account, there's a particular trading style that I'm following. It means that I am swinging. So I swinging, I don't close trade at the end of the day. You understand? I don't close trade at the end of the day. So it means that I will factor into this from the onset, from the maximum drawdown. I consider that I do my calculation, but I'm following. Then I move to what? Personal daily. So the personal daily means that, personally, it means that every day, once I'm monitoring my trade, I make sure I don't move around $60. If I'm getting to that, I'll close it automatically. I'll close it manually. So I don't want to move around every day on 5K account. I don't move around that. Now, it may look a lot, but it is a calculation that I've done. So the system will take care of it. The work will come up later. Now, when you move to the instrument, I told you, at CMG, we deal with niche. So niche means that I've studied all the pairs, about 8 of them, the major currencies, right? Then the ones that I've mastered them, I think I have upper hand, I choose them. So when it comes to DXY, that's the American dollar, I have actually mastered that. I'm not a guru, but I've mastered that. That is my niche. So any pair that has any USD in it, I won't trade it if they are not EU or GU. Right. Now the EU means Euro USD, the GU is what? The pounds USD. It's initials that I've used. Now if you check XU means it's gold. That is it. Now I go to what? The lot size. Now when you look at the lot size, just above it, you see the pips. Let me see, zoom here. You see pips. Under pips, you see less than or equal to 45. For what? The pairs of what? EU and GU. You can see a stroke. The dollar size below that, if you have 0.05, stroke 0.05. So for EU and GU, the lot that I will go is 0.5, 0.5. Under no circumstance will I go above it. But I can still go below. That is still part of the risk management. Then when I move to gold, I should, under no circumstance on 5K account, should I go more than 0.01. That is a correct calculation that I've done. You have to take care of this. Now, I think with the idea, you can actually pause the video, read down everything down. And this is applicable to all the account sizes that we have here, right? Account of the accounts and all that. So if you check the lower you go, you can see that the account sizing increases. The 10K, 100K, 25K, and then 20K. All of them, they are the lot sizes and the risk management are not the same because it's a calculation, it's a percentage. So the moment I put in the percentage, I know the calculation. So once I've done these things, you can see the lot size and that I have everything there, demarcated, prepared in my book. If you are IT personnel, in fact, once you are using the PC, you use PC and phone for trading. So you should have this sense on your phone. Stick to this. The moment you go out of this, that is where you begin that you are losing. Now, even when you are within this and you are trading and following everything and you are still losing, that's where you get to know that maybe this particular strategy is not helping, then you can change it. Right? So this is how we do things in trading. Be structured. Right? Be very, very, very structured. So with the idea, now let's go to the site myfxbook.com. Still, we are going to use the app because I'm using the phone mobile for this demonstration. On your PC, just you can log in, go to myfxbook.com, log in with your sign up actually with your Google account for convenience. And then when you log in on your PC, you see the menu and then the menu bar, the items there, right? And then you can move to what? FX calculator. FX calculators, actually FX calculators, and then you see that. So on your phone, let's move to here, the app. Once again, I'm going to show you the app. This is the app, right? The app, the right side. Open that. My is FX. Open that. So when you open that, this is what you see. The normal interface. Go to the menu there, right? And then click what? Calculators. On the phone version, it's calculators. But on the web, you see FX calculators. Hit that. So when you hit that, under here, you see three things here. You see positions, pip value, and then margin. Now here is going to cover everything that we talked about. So we see here the currency pair, the account currency, the USD. If any asset that you are trading, that particular currency will be there. In my case, it's Euro USD. And then we have the account size. Then we have the stop loss, we have the risk percentage, the swap with money, that will not be the concern. Then we have the lots. Now when it comes down, you see calculate clear, and then the pair down here. So let's look at the position size calculation for this particular currency that we are trading. We can actually change this. We have the options here. So whatever currency you want to trade, just populate it. Now, what account size are you trading? We told you 10,000. 10,000. Now, 10,000, what is the stop loss? So this stop loss, you have done your calculation. So, let's say, stop loss, in my calculation, I said less than or equal to what? 45. Right? I can actually do it 40. So it depends on where I am doing after the analysis, where I'm going to pick my entry and then my exit. My entry and then actually the stop loss. That is the calculation. But here is what the stop loss, the SL, in pips. So put it down. You still have the figure at the back of your mind. How much you want to lose in that particular trade. So you come down to the percentage. We have also looked at that. We have also said that the calculation, what did I say? The ratio should be within 1 to 2%. So I'm sticking to the lowest, which is 1%. So put it down. So always, that means that you also have to stick to around 1%. Is the percentage based on your account and then how much you want to lose. So that is very subjective. How much do you want to lose? It depends on you. And I'm willing to lose 1% of my 10,000. You understand? So 1% of my 10,000 will be around what? What is it? $100. So don't worry. So let's see. Now, you see the lots, right? So the lots and then the lot size. So let's see what happens here. You hit calculate. So when you hit calculate, you see the money. Under that, you see money USD, $100. The units in terms of the lot size or the contract size, you see that. Then you see the lots. You understand? So here it means that this is the lots that you can actually trade, going with what? The 40 pips and that is it. I hope you understand. So just use the web version and you understand it. Just be playing around. That is how we learn. So I'm introducing you to it. Use it and you understand the calculation. It's very, very easy. Now let's move out to where we can actually have everything in a snapshot. Maybe this position size looks quite conceptual, or even though it's easy for me, but it may look conceptual to you. Let's move to the pip value. Now when you talk to the pip value, it told you how much a pip actually costs you. How much a pip will actually cost you. So once again, the pip value, you can actually come here. So on the web version, you see what pip calculator, right? When you go to the FX calculators, move again. You see a number of calculators there. Move again to what pip calculator, right? So when you move to the pip calculator, you see something of this or similar to this, even though there's a slight difference. So that is it. Now once again, you see the current account currency there, the lot size, and then the currency pair. The currency pair can be chosen from here. You can choose that particular one that you want to populate. You understand? So that is it for the currency. Sorry, this is the currency that you want to check. And then for the currency pair, you can come here. You can choose multiples of them or individuals. So if you check down here below the calculate, you can see I have the currency Euro USD, JPY, GJ, GU, and then gold. So everything is here for multiples because these are the currencies that I trade. I showed you in the picture, in the image. So I've just populated them here to make things convenient for me, right? So I come to trade size, which is basically the lot size, and then we have how many pips. I told you around 40, or let's say 45. So I calculate. You see them here. So we have the price where you entered, the pip value, how much is one is costing, and then the actual result, which is down here. So you see for Euro USD, you see the 450. You see again the pounds USD, you see 450. These are correlated pairs. If you don't know what are correlated pairs, check in this video description on the channel. You understand what are correlated pairs. It's a very important tool that you don't want to miss. If you have an upper hand in this, it's very, very good. They have the same pip value. Yes, that's for Euro USD, and then they have the same pip value. So with the same number of lots, like the 45, you have the same amount, 450 and 450. You understand? So that is it. And now one trick with gold. With gold, you have to be very careful. With gold, the pip can be, gold has to deal with some different kinds of units, ticks or so. So we don't call them pips, but ticks. Right, so that is it. So you understand. So before you enter a trade, have this done. Now with time, if you have done this in your book and then you have them offered, sometimes you don't even have to come back to check because it's something that you have structured your position yourself into. So you always know that for 45 pips on Euro USD at this particular lot, I'll have this amount. Listen to this very carefully. They are very relational. With this particular amount of pips, right, on this particular pair, with this particular lot, I'll have this result. So you have to know all these things. That is, so with time, you don't have to come back to check these things. You'll be good to go. Like I've written mine down. With time, you'll be good to go. You understand? So I think basically that is what we have to say in position sizing. If you are still finding things difficult and then you don't know where you are around, just hit me up and I'll let you know. Right, I'll help you one-on-one. So thank you very much for watching. I'll see you in other episodes series. Bye for now.